The objective of this presentation is basically to discuss what's going on globally right now. As you know, economic growth is slowing down. There are uncertainties about the future of the Eurozone, which might affect the rest of the world. In fact, we saw that to some extent last week when foreign investors started to sell treasury bills in Nigeria. So basically, we'll start with the global outlook. Then we'll discuss how it affects Nigeria, and we'll discuss some specific macro indicators in Nigerian states. So I think the concern in 2012 is that economic growth is likely to slow sizably in some parts of the world, especially in the Eurozone. I think now there is a consensus view that the European Union or the Eurozone is going to face a recession. Sorry about that. So, in Europe, growth in 2012 is now projected at minus 0.3%, which frankly could be even worse because, as you know, some of the countries are really in a very bad situation. So, Greece, for example, in fact, is likely to exceed the Eurozone in coming weeks. But you also have countries like Spain, Portugal, Ireland, and even France, which face significant distortions in terms of public debt, in terms of fiscal imbalances. And I think the most worrying part is that they seem to be unable to actually adjust those imbalances because of the lack of flexibility in the economy. The other concern is that growth in China is also slowing. So China in the 2000s used to grow at 10–11%. The projection for this year is slightly above 8%. I mean, 8% might look like a high figure, but in reality, it's barely what China needs to contain unemployment and to avoid any significant social dislocation in the country. So if China slows, the impact obviously is that demand for commodities is likely to decline, which could affect the oil price and all the minerals that are key to African countries. I think the only upside in the developed world is that growth in the US is still expected to increase a little bit to 2.1% from 1.7% in 2011. But frankly, 2.1% is not that impressive at the end of the day. So the irony is that increasingly it's emerging markets and developing countries that are driving global growth. And if you look at Africa's case, I think it's quite obvious. Africa this year is likely to expand in excess of 5%, which is a good performance. And actually, that 5% is somewhat biased because South Africa accounts for probably 30% of Africa's GDP. South Africa will probably grow at 2.83%. So it's bringing the overall aggregate African growth rate down. But I think, what could happen if Nigeria's GDP is revised, the weight of Nigeria in the overall African GDP will increase, and as a result, because Nigeria is growing faster, it's even possible that African growth could be revised upwards. Now, how does slower global growth impact African countries and financial markets? I think the best proxy for sovereign risk is probably the euro-dollar exchange rate. I mean, what we've noticed in recent months, if not years actually, is that every time that the euro weakens against the dollar, there is actually some sort of flight to safety and a sell-off in risky assets. So it's exactly what happened last week. As the euro weakened against the dollar because people started to price the exit of Greece of the Eurozone, international investors across the globe started to sell their risky assets in emerging markets and frontier markets, and they switched to the US dollar assets. So as a result, US treasuries declined because of the demand, and yields in emerging markets and African countries, for example, increased. So it's exactly what we saw in Nigeria, where foreigners started to sell T-bills, and the yield of the T-bills increased last week, which also put pressure on the exchange rate, because obviously they were selling T-bills so that they could exit Nigeria. So they needed some effects. There was increased demand for dollars, and the naira weakened a little bit. Now, if Greece leaves the Eurozone, and if other countries like Spain or Portugal are under the same pressure, there is a risk that actually the euro-dollar rate, which is currently close to 127 or so, could go further down to maybe 120, 115, who knows, maybe even lower. So in such a case, obviously the risk would be that you have a massive flight to safety, and that all African currencies and the naira come under pressure. But I think that to some extent must be a little bit mitigated by the fact that the foreign inflows, the foreign holdings of Nigerian T-bills and equities and bonds are quite modest actually. This is not 2008 when you had a massive outflow that led to the currency depreciation that took place at the time. We probably have $5, $6, $7 billion of foreign holdings in Nigeria, with foreign reserves at 37 billion. To some extent, the central bank could probably be able to withstand such a shock. I mean, the next slide also is quite interesting because it shows you a long-term trend. Given the slow economic growth in the Eurozone, in the US, the central bank in those countries have cut policy rates to virtually zero, or not far from there, at least. And the impact is that, well, for investors in those countries, it makes sense actually to invest overseas. Because frankly, you know, if you get a return of 0.5% on your money, what is the point? So this is probably the reason why we started to see more and more inflows into Nigeria, Kenya, Uganda in recent months. Especially as the exchange rate stabilized, people became more confident in the West that the naira was probably going to remain stable. So they borrow money at 0.5% back home, and they invest here, they get 15% to 16% at the short end of the curve. And I think that's a trend that's likely to remain. So this trend to some extent contradicts the previous slide. So in the sense that, you know, if risk is on, then this line actually holds. The paradigm in this line holds. So in other words, people will invest in emerging and frontier markets. But if risk is off because there is a dislocation in the Eurozone, then although you're going to have high yields in Nigeria, people are not going to come to invest, just because they will sit on cash to be on the safe side. Now, you know, you could argue that the financial outflows are maybe not a massive risk in Nigeria's case because you don't have that much foreign capital in the system. But the other major risk is that as global growth slows, you could have a sharp drop in the oil price. That would be really a major risk in Nigeria's case. As you know, oil accounts for 95% of exports in Nigeria, 80% of government revenue, and only 15% of GDP. So obviously, if the oil price were to decline to $80 per barrel, $90 per barrel, I think some sort of panic will start domestically, and people will start betting against the local currency. So the dollar demand will probably increase. I think on the upside, this is somewhat an unlikely scenario. The Bonny line oil price is now at $110 per barrel. It's declined from a high of 128 in March. But most of the analysts on the commodity side still think that it's probably going to hold above $100 per barrel this year. I think the reason is that, you know, the slower growth in 2012 is nothing compared to the major recession that we had in 2008 when the oil price fell to $40. I mean, it's not the same magnitude of distortions. So as long as the oil price remains at least slightly above $100 per barrel or close to that, I think Nigeria should still do fine. But I think the issue here is that, you know, although you have the oil price at $72, per barrel in the budget, in the 2012 budget. In reality, the magnitude of fiscal expansion in Nigeria in recent years has been substantial. So the fiscal break-even point seems to be much higher than the $72 implied by the budget. So in other words, fiscal consolidation is really, really important in Nigeria's case because obviously in the long run, maybe not today, maybe not next year, maybe not in 2014, but at some point, the oil price will definitively fall below $70 or $60 per barrel in the future. And if the country has not enough foreign reserves and savings, fiscal savings by then, it will definitely be problematic. For the sake of time, I'm just going to go through the most important slides. I mean, domestically, in terms of economic growth, I think it's still robust. I mean, yesterday we had the figure for Q1 12, so the first quarter of 2012, growth declined by 6.1%. It's always lower, a little bit lower in the first quarter, and that was primarily because of a drop in agricultural output. But at the end of the day, 6% is still high by international standards, so I think we shouldn't worry too much about that. I think this year growth is likely to be slightly above 6.5% or so, down from 7.3% in 2011, but I don't think it's a big deal. What's really important is to have growth that's inclusive and sustainable, because you can have very high growth rates, as shown by the next slide, almost static high growth rates, but if it doesn't really change for the common, if it doesn't change anything for the common man on the street, I mean, what's really the point? So you need to have a growth model that improves infrastructure, that is inclusive, that reduces poverty and unemployment. That's really the key objective, I think. And so there are key structural reforms, clearly, that have to be implemented in order to achieve that. One of those, for example, is the power sector reform. It seems that there is some marginal progress in the sense that the PHCN was disbanded and the government intends to privatize the successor companies, but again, the pace is very, very slow. The other reform is the PIB, because what's happening is basically that oil majors have limited incentive right now to invest more in Nigeria because of the uncertainty around the regulations. And another key reform, obviously, is the sovereign wealth fund, because you need to codify the way you save fiscal savings. The excess crude account worked fine for some time, but clearly not anymore, because the funds are constantly monetized and shared among the three tiers of government, and there's very little savings in fact. Another interesting point is that actually on the revenue side, Nigeria is doing quite well. I mean, if you look at the federally collected revenue in Q4, Q3 2011, it reached record high levels, even higher than in 2008 when the oil price surged to $140 per barrel. So clearly the issue is not so much on the revenue side. I mean, it's consistent with a very high oil price. The big problem is more really on the spending side, and if you look at the chart on the left-hand side, you will see that, especially in 2009, everything that was collected was almost entirely allocated to the two tiers of government. So it seems to be a bit less the case now, but I think the difference between the two lines probably went to service the subsidy in 2011. And if you look at the second chart, which is the amount that's basically channeled from the excess crude account to the budget on a monthly basis, well, here it's quarterly. I mean, those figures are still quite high. 810 million naira in the third quarter of 2011. That's really huge. And those are the transfers that, let's say, are expected, because every month some money is taken from the excess crude account to plug the nominal fiscal deficit. But on top of that, you also have unexpected disbursements. So FAC could decide that today they want to disburse $2 or $3 billion for various projects. And so clearly, I mean, this is a problem because of this stance, it's very difficult to accumulate fiscal savings, which are needed when you are a more producing country. So we hope that the sovereign bond fund bill will eventually be effectively implemented, which could address these imbalances. But obviously, there's well, it's quite contentious, to say the least. On the foreign exchange flow side, I think the situation is improving. What we saw in January is that for the first time in a long period, actually, the FX balance through the CBN was in positive territory. And I think this figure is probably likely to improve in February, March, and April because of the foreign inflows into the TBL market. So clearly, it's not as if there are no dollars coming in. It's more that for a long time, there were structural leakages on the financial account side. For example, the high demand for dollars because of the subsidy and so on. But structurally, because Nigeria is an oil-producing country, it should have a large current account surplus. So in the FX flow balance should not really be a problem per se. The exchange rate, I mean, look, we're still quite confident that the recent weakness, so last week's weakness, the move to 159, is probably short-lived and will not be sustained. So I don't think that the currency is going to reshoot to 165 or 170. The central bank has been very proactive in selling dollars to the market in recent days, so they capped the higher move. I mean, obviously, because we live in a very uncertain world, it's possible that you could have other short-term spikes, but as long as the oil price remains high, as long as there's no domestic panic, I think we will probably end up the year somewhere between 155 and 159. Let's say 156, 159, in that range. The risks, obviously, again, are exogenous to the oil price and sentiment, depending on what happens in the Eurozone and in terms of foreign investment. Now, in terms of credit to the economy, I mean, if you look at the official data, it seems that there is a surge in private sector lending. 50.7% year-on-year in March. In reality, I think it's more because of a base effect in the time series. So last year, when AMCON acquired NPLs from the banking system, the NPLs were removed from the time series, so you have a very low base effect in the first quarter. So year-on-year, the growth rate is high. But if you look at the month-on-month figure, actually it's quite low. It's only 1.1%. And obviously, the issue on the credit side remains that it's primarily the tier 1 names that can access credit at preferential rates. So if the prime lending rate in the bank is 25%, they will access it well below 25%. But unfortunately, everybody else, so tier 2 names or the retail segment are struggling. The high rates, the high policy rates clearly are not helping. But even when those policy rates were very low in 2009, 2008, access to credit was also quite limited. So clearly there's a structural issue which will take time to address. I think the risk profile of borrowers is a concern for the banks. The fact that we don't really have a corporate bond market is also a problem, because if you had a corporate bond market, the SMEs or the tier 2 names could issue bonds, and that would decrease their reliance on bank financing. So the banks would then structurally have to decrease their lending rates. It's the way forward, but I think it's a structural change that will take a long time. What we saw also on the upside is that apparently there's a little bit less of credit to the government, because at some point in 2011 especially, and late 2010, the government was basically crowding out the private sector because of the surge in domestic bond issuance, because the excess credit account was completely depleted in late 2010. It seems to be somewhat less of an issue, but it's still a problem. On the inflation side, our view is that we're probably going to have a few more increases, and inflation will peak at 14.4% or so in July, August. And then it will start declining. So we'll probably be at 12.6 or so by December, and maybe even high single digits in 2013, early 2013. I mean, I think the key issue this year is that because of the increase in food prices in January, you had a jump month on month, so you have a higher base, and that higher base is causing a transitory shock in year-on-year terms, but in reality, if you look at the month-on-month inflation rate recently, it's been quite low, only 0.1% in April. I mean, obviously, a lot of people feel that these inflation figures don't reflect what they feel on the ground, which I guess is another issue, but you know, we have to use the official stats to project. Now, I think the last slide is quite important. I mean, it's on the monetary policy outlook. So yesterday we had an MPC and the central bank kept the MPR and the other policy rates unchanged at 12% for the MPR. It's the fourth time that they keep rates unchanged. And I think what's interesting is that the tone of the MPC statement was quite dovish, in the sense that I haven't heard Governor Sanusi being so focused on economic growth internationally and domestically for a long time, which suggests that at some point in 2011, in 2012, there might be an interest rate cut. A very modest one, but it's becoming increasingly a possibility because, you know, from a public policy standpoint, it's becoming difficult to have such high lending rates in the economy. So the central bank will probably be able to show that it cares about the real economy at some stage. But on the other hand, it is very difficult for them to cut aggressively, because if they do that, then there's going to be too much liquidity in the system, and that liquidity will start chasing US dollars the way it was last year or 2 years ago. So they will probably cut modestly, and at the same time they will use open market operations to control that liquidity, especially after the FAC allocation. And what we've seen in recent months is that after every FAC allocation there is another normal to remove the liquidity, the fiscal liquidity from the system. I mean, clearly, it seems that the biggest risk to the exchange rate then comes from the fiscal side. So you really need to have some sort of fiscal consolidation to remove that threat on the exchange rate side, and in this case, the central bank will be then more proactive. So I think that's probably the main conclusion.